SIP versus lump sum investments. What would happen if someone invests 10,000 rupees into a mutual fund every single month, and compare it to what if someone invests 1,20,000 per year into a certain mutual fund, right? A person who systematically invests 10,000 rupees every single month versus someone who does a lump sum investment. This is what a lot of people want to know. We all know that the right way to make a lot of money in your life is to first earn a lot of money, then to manage it and use it really well. And to manage it and use it really well, you will definitely have to invest that money into the market. And once you do this with a lot of patience, then all the best, success is what is waiting for you at the end. So what to invest, where to invest, we have covered all of this. You can check it out in one of our previous videos here. We talk about where exactly you should be investing, how much money you should be investing, all that has been covered very well in depth. So this video is very different. It is talking about lump sum versus SIP investment. So basically you have the money to invest and you know where to invest as well. And the only question that is remaining is how you should be investing that money. Should it be all invested in one go, or should it be broken into small pieces and invested consistently throughout a time frame? So first let us understand what an SIP or a systematic investment plan is. Then we'll go on to a short story comparing SIP and lump sum investing. SIP or systematic investment plan is nothing but investing a predetermined amount of money at regular intervals. You can compare it to an RD in a bank, a recurring deposit, if you know what it is. Let's say you're depositing a sum of 10,000 rupees every month into a recurring deposit. It gets debited from your account and then you're putting it away into a different account, calling it as a recurring deposit. And once at the end of the year, once you look into that RD account, that recurring deposit account, you'll be seeing that you'll have invested 1,20,000, that is 10,000 into 12 months, and you'll be having some change as interest as well. Yes, this is all what an SIP is, a regular fund put into a different account for investments. But in the current time that we're living in, an SIP is usually referred to as a mutual fund investment, which happens at the start of every single month. And what happens at the end of that 1 year, you go into that RD account, you withdraw all of it, and then you decide to invest it all into an FD at one go, then it will be called as a lump sum investment. Now that you understand very easily what is an SIP and what is a lump sum investment, we'll go into a short sweet story to help you understand the pros and cons of SIP investments. So let's look at the story of two brothers, Ram and Shyam. So their father had invested in an LIC policy many years back, which is maturing right now under both of their names, and they would be getting a sum of 10 lakh rupees in their hand right now this month together. So Ram and Shyam have fairly good income also coming into their hand every single month, and they have a potential to invest 10,000 rupees every single month throughout the rest of their lives. So Ram decides to put all of his money into a lump sum investment. That 10 lakh rupees that he got from his father, he'll be investing it at one go into an equity mutual fund. And Shyam, on the other hand, decides to split up that lump sum investment and split this first 10 lakh investment over the course of multiple months. So here what is happening? Ram is doing a lump sum investment into the market and Shyam is doing an SIP or a systematic investment plan. And what happened with Ram is, as usually the case with someone who does not know much about the stock market, he unintentionally invested at the peak of the market. And unfortunately, the market dipped down just 1 week after his investment. And when the market moved down, his equity mutual fund also fell down. And he was very sad. And what can he do? His investment, he could have had his investment at a much lower price in the market. So his emotions are very real, and I hope you can relate to him, because he invested at a peak and the market fell and there was nothing that he could do about it. Yes, it was a long-term investment, but then he still could have gotten a much better price if he waited for just 1 or 2 weeks. On the other hand, Shyam decided to break up his investments over multiple months and invest small chunks into the market. So this 10 lakh rupees that he got, he decided, I'll be putting nearly 80,000 to 1 lakh rupees into the market. So what was he able to do? At the peak, just like Ram, he also invested a certain amount of money, but then when the market fell back down, the very next month, he could invest another set of money. When the market moved back up, he could invest again, and he got all the advantages of averaging in the market. And in the story, Ram's ego was hurt, and the future potential investments that he also had to make, that also he tried every time he tried to time the market. Sometimes he would win, sometimes he would lose. But at the end of the day, what would happen is that Shyam, who consistently kept on investing into the market without looking at where the market is now, he was just consistent. That's all he did. He would end up with more wealth created over the long term. So this is where the benefits of an SIP shine through. Let's quickly look at what all are the different pros and cons of an SIP. The first advantage is called as rupee cost averaging, because when the market moves up, Shyam is investing, let's say 10,000 or 1 lakh rupees every month into the market. When the market moves up, the mutual fund price would also move up, and at the higher price he would be buying lower quantities of that said mutual fund. And when the market moves down, again the total investment that he is putting in, it's the same, and he'll end up being allotted more units of that very same mutual fund. So over the long term, Shyam is buying more number of units at lower prices, and whenever the market moves up, he is buying only lesser number of units. The second advantage is disciplined investing. Let's be real here. Most of us will treat our SIPs as EMIs that is going away from our account, and as you know, when we are putting in EMIs, we do not think of it for the rest of the month. So it is purely passive investments that you'll be doing. But on the other hand, whenever you're going to do a lump sum investment, you'll always feel like timing the market, and in the worst case, you might also end up spending all of that money. The third advantage is that you can start small. The only thing that you have to think about is consistency, and that will help you build wealth over the long term. If you have any doubts, you can check out this SIP calculator that we have made. I'll put the links in the description and in the pinned comment as well. So go there, put whatever monthly amount you can put into an equity mutual fund. For the sake of simplicity, just put 12% annual returns which you're expecting, and put the number of years. Put the number of years as 5, 10 or even 15 years, and see the magic of compounding as I'm talking about it. And the major and the only advantage is, if you know how to time the market, you cannot do it. I don't feel like that is a big problem for a lot of investors out there who do not know how to time the market. In fact, if you know how to time the market, do not even invest into a mutual fund. Think about futures, options, derivatives, or even stock investing. Why do you even have to think about SIP investment? I would say keep SIP investment as the holy grail that everyone should have, right? Everyone should aspire to increase the amount of SIP that they're doing monthly into all of their investments. So I'll show you the proof here as well. We'll quickly go into an Excel table which shows you the performance of a UTI Nifty mutual fund over the last 10 years. So let's first take the case of Ram, who invested lump sum into that mutual fund, and let's take the case of Shyam, who invested month by month into that mutual fund as well. So first, let's look at the brother who has invested 10,000 rupees every single month into this mutual fund without fail. And what he has done is, without looking at the price, first calendar day of the month, he would just invest 10,000 rupees into that mutual fund. And on the other hand, we have the brother who decided to invest 1,20,000 every first day of the calendar year as lump sum into that mutual fund. And let's quickly compare what would have happened if both of them started at the date of 1st January 2014 and continued all the way till 1st January 2024. So Shyam, who is the brother who had invested in the market only through SIPs, he would have put in how much amount? He would have put in 120 months into 10,000 rupees. That is nearly 12 lakh rupees which he would have put into the market. That is correct. And he would have been assigned units of 17,337 units into that mutual fund. That is worth nearly 25.82 lakh rupees. And on the other hand, if you're looking at Ram, who had invested in this mutual fund only once every single year with the same amount of money, and he would also have invested 12 lakh rupees into the fund, but he would be sitting with just 15,146 units in the fund. That is worth just 21 lakh 47,000 rupees. So yes, over the long term also, SIP is a clear winner. So let's get to the conclusion. SIP is the best option for investing in the market for all the reasons that we have said. If you want to do lump sum, if you have a large amount of money sitting in your bank account which you do not want to keep it there, invest into debt mutual funds. Do not think about timing the market, do not think about lump sum investment into an equity mutual fund. Because the fact that most people do not understand is how difficult truly it is to time the market, especially over the long term. That means a normal person might get it right once or twice over the period of a few months, but then every time later he would start going wrong about it. So the only thing that he has to do if he wants to truly build wealth without knowing anything about the market is to invest his SIP amount into an equity mutual fund. Just like an EMI, the SIP amount will be debited from your account and psychologically you will end up not even thinking about it. The best kind of investment. And if you're truly believing that every time you can get a better price in the market, as we talked about in the previous video, invest or keep aside 10% of your monthly mutual fund investments, put it into a debt mutual fund and call it as your opportunity fund. Whenever the market crashes by 8%, 10%, you can invest all of whatever is in there in the opportunity fund back into an equity mutual fund. So again, you're truly building wealth over the long term. You will be building a corpus also, calling it an opportunity fund, which you can use whenever the market crashes. So yes, this is Ajay Ajith signing off. Get subscribed if you like the video. See you again with another one. Bye bye.